Welcome to Market Domination. I'm Julie Hyman. That is Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
If you think about big tech, which is a collection of 6 stocks, that's been the fulcrum for this market and holding it not just from earnings, from returns perspective as well. And I think what's interesting is that their earnings as a group is moderating from extremely high levels.
The JOLTS report is actually quite informative. It does show that there is much less tightness and continues to be less tightness over the past 3 years. We've seen job openings come back down to levels that are close to what they were before the pandemic. But importantly, in this report, we saw a slight rebound in the hiring rate, which shows you that essentially the floor is not falling under the labor market.
If you look at company-owned stores, margins clocked in a little bit below 13%. For the full year, we project store-level margins down about 120 basis points. Looking forward, though, guest-led growth is a lot more sustainable. It looks to me like McDonald's has righted ship here.
We got 1 hour to go until the market close, and we're taking a look at the major averages here, Josh, and they're kind of muddling along, at least if you look at them together, because the Dow is down about 68 points today, but the S&P 500 is higher by about 1/3%, and the Nasdaq touched an intraday high, and it looks like it could close at a record high for the first time since July 10th. We had some economic data out today. We had JOLTS, which showed the fewest number of job openings since January of 2021. But on the flip side, consumer confidence coming in better than estimated.
Yeah, JOLTS results soft. And maybe, listen, we've had any number of economists argue, including on this very show, Julie, that there's signs the labor market appears to be cooling. Of course, big jobs report on deck. Consumer confidence was interesting because that did really pick up. Nice jump. It's interesting you kind of pull back the chart this year and consumer confidence kind of ebbs and flows, but consumer spending has hung in there.
Right, definitely. Yeah. I mean, and a lot of economists like to point out I'm doing something differently perhaps than I'm saying, for sure. So, we do have some macro stuff, but we also, of course, since it's earnings season, a lot of this is also driven by individual companies. Now, Bitcoin's our top trending ticker, which we're going to get to with our Jared Blickery in a little bit, pushing up towards new highs. But a lot of this list on trenders is earnings. Pfizer down 1.4%, SoFi down 6% following its earnings, Ford down 8%, Crocs, which we're going to get into, down 19%, and then some companies that have yet to report. But the point being is that, again, you always get a mixed earnings season. We know by and large the companies are beating by a lower margin than they have in recent quarters, at least thus far, and we'll see if that trend continues.
Yeah, now we got big tech on deck. So now it's really showtime, of course, with Alphabet after the bell. Heading into the print, it's had a nice run, although also, underperforming some of those Mag 7 names like Amazon, like Meta.
Well, and notable, again, that the Nasdaq Composite could close at a record just as we're really about to get into the thick of the Mag 7 earnings.
All right, well, let's get more on this because Alphabet is indeed set to release its quarterly results, kicking off a big earnings week for U.S. tech giants. And here with what investors should watch for is Yahoo Finance's very own Dan Howley. Dan.
Yeah, Josh, there's a number of things I think that are going to be on investors' minds. Chief among them, where obviously AI fits into the earnings announcements, specifically coming from Alphabet, but then Alphabet's competitors, Microsoft, Amazon, and then the kind of big winners of the AI boom so far, the chip companies, whether that's NVIDIA or AMD, which is also reporting today. For the quarter, revenue is expected to come in at $86.4 billion. That would be up from $76.6 billion in the same quarter last year. Earnings per share, $1.83, up from $1.55. Big news on the cloud revenue front. That's where people are going to be looking. That's where you get some of those AI earnings. That is expected to come in at $10 billion, and that would be up from $8.41 billion in the prior year. And then ad revenue, obviously, where all the bulk of Alphabet's revenue comes from, $65.5 billion. That would be up from $59 $5.6 billion. And I think a few things to keep in mind here when it comes to AI is it's not just what you see when it comes to AI overview in the Google search results. It's also the enterprise that's feeding into that Google Cloud area. When you have something like Gemini for workspaces, that's part of their enterprise dealings. Also on the advertising front, when it comes to AI, it's also being used to help advertisers build out ads. We're seeing that with Meta and some success there. So we're expected to hear more about that later this week. But it is going to continue to be about AI. Also keep your eyes on the spending.
We will definitely be keeping our eyes on all of that. A lot to consider as we look at those earnings. Thank you, Dan Howley. Appreciate it. And there's another biggie after the bell as well. That is AMD. Here with a preview of those numbers, Yahoo Finance's Akiko Fujita. Hi, Kiko.
Yeah, Julie, investors are expecting yet another strong quarter from AMD, with the street estimating earnings of 92 cents a share on revenue of $6.7 billion. As Dan said with Alphabet, the focus here will be squarely on artificial intelligence yet again, with investors specifically looking for data center revenue. That surged in the second quarter to $2.8 billion. That was more than double the revenue during the same period 1 year ago, prompting CEO Lisa Su to raise the guidance for AI GPU revenue to exceed $4.5 billion for the year. AMD, of course, looking to chip away at NVIDIA's dominance around artificial intelligence hardware. The results today come on the heels, though, of what was considered a lackluster AI event earlier this month, where AMD revealed its MI325X chip. The company touted it as better than NVIDIA's H100 chip, but that led to its biggest single-day decline in September in terms of the stock. The street remains bullish on the stock, given that AMD is seen as the most serious competitor to NVIDIA. More than 80% of analysts maintain a buy rating on the stock, and they are looking ahead to 2025. The company is set to release its latest series of advanced chips, the MI350, in the latter half of next year. Analysts certainly going to be looking for any color around that, what kind of demand that's likely to spur. And then, of course, as Dan mentioned, spending's going to be a big focus. Investors looking out for capital expenditures, with the company reporting $154 million in CapEx last quarter. Expect that number to go even higher as AMD looks to stay ahead in the AI race, guys.
All right, thank you, Akiko. Now, beyond the earnings out today, we have some key economic data set to drop this week. And for more, let's welcome in now Jose Torres, Interactive Brokers senior economist. Jose, great to see you.
Absolutely, Josh. Great to be here. Hi, Julie.
So maybe, Jose, actually start with the economic data maybe today, which was interesting because it was mixed. I was talking about with Julie at the top of the show. You had JOLTS results, soft. You had consumer confidence, though, really jumped. What did you make of that?
Absolutely. So JOLTS, hard data coming from institutions, consumer confidence, soft data coming from households. Consumer confidence, a lot stronger than expected, strongest we've seen since January. Why was it so strong? Because of stocks. Folks think that equity prices are going to continue to increase and feel the most optimistic they have about equity performance.
Do you think election had any, I heard your colleagues, other economists, there's some whispers about that.
Absolutely. There's expectation that the rising probability, actually, that there's going to be a red sweep when you look at our IBKR forecast trader platform, brand new, by the way, ladies and gentlemen. When you look at it, you have former President Trump with odds right around 63%, GOP control of the Senate up at around 90%. And now the House, Josh and Julie, this one is going to be interesting. It's tight. It's nearing a coin flip in terms of whether the Republicans or the Democrats are going to control the House. As far as investors are concerned, based on the conversations I'm having, they'd like to see a red sweep because they think that that's going to add further stock gains, lower taxes, deregulation, more enthusiasm. You look at Bitcoin, its performance in the last 30 days, roughly 10%. DJT performance in the last 30 days, totally off the charts. Finally, on this point, thinking that the sectors and areas to benefit most are going to be financials, industrials, energy, defense contractors, and small caps, which, by the way, small caps, sorry, last point here, small caps have actually performed extremely well considering that from the Fed's cut, 50 basis point cut on September 18th to today, the 10-year is up roughly 70 basis points. And small caps, they're not doing terrific, but they're still hanging in there and doing well.
Yeah, that is definitely surprising. I just want to pick up on something that you're talking about, which is that the sentiment in the market seems to be positive around a Republican sweep, including a Trump victory. Your peers in the economics community are by no means necessarily on the same page that it will be economically positive, right? So talk to us a little bit about that, how you view potential outcomes. I mean, and as always, it's hard to game out this stuff exactly. There's things that candidates say and then things that happen, but how are you thinking through that?
So one thing that we're seeing specifically in our IBKR forecast trader is that either candidate is probably going to increase the national debt and not solve that problem. So we're seeing that in the market. Now, personally, I think that the GOP has a better chance of getting the budget more in control. We've heard Elon Musk talk about a lot of draconian government spending reductions, which is what we need. If we decrease spending and keep growth positive, lighten up regulations, lighten up taxes, spur economic activity.
But they're going to be bringing in less revenue also by lightening up taxes. I mean, can that really be made up for by slashing government spending to that degree?
So if, huge question mark.
What if he gets rid of income taxes, which is something that Trump has floated? I mean, that's a huge, huge revenue source for the federal government.
Absolutely, and on the campaign trail, those proposals tend to be more extreme. You got to work with Congress, you got to work with the House. A lot of those things aren't going to fly, once the declared winner is in the Oval Office. However, we have seen in the past that reduced tax rates have actually increased revenue. We saw it different across party lines, where you saw with the Coolidge administration, with the Reagan administration, Kennedy administration, W. Bush administration, Trump 1.0. So, there is a chance that when you reduce those taxes and you create those incentives, that, economic activity from the supply side, is, and it's been a debate, Julie, that's been going on for a long time. I happen to be more of a supply side guy. A lot of the folks in the economic community tend to be more of a demand side folks. They think that when you bring down government spending or you lower taxes, you have some problems.
Let me ask you, getting back to some economic data, we're going to be getting this. We had the big jobs report. A question I had, though, for Jose, for you is that you got not just that report, but a number of the data points that are going to be coming at us at The Economist, and by extension our central bankers. Wouldn't they be pretty messy and noisy, given you got hurricanes, you got strikes? I mean, with these data points, do you think economists like yourself, are you going to be able to sort of, kind of read the tea leaves, get at the underlying trends there?
Well, I mean, the data has been definitely going to be more noisy and murky this time around. Yeah. But post-pandemic, I mean, we've been dealing with these problems for so long. I mean, for the last 2 years, I've been coming on this program, and a lot of my views on where the economy is going has, been shifted in 2 to 3 months multiple times, and a lot of it, we got to look at moving averages. We got to look at the buffet of data, right? Government sources, private sector sources. What are commodity prices saying? What are financial market gauges saying, right? All those things, together, do point to an economy that's on really solid footing. I think the two drivers today of consumer spending are really the stock market and employment conditions, right? And the stock market is just doing terrific. It's up 24% year to date, roughly. Last year was up 24%. That's doing well. That's helping out a lot of the folks that have the bigger investment accounts. They're helping their children. They're helping their grandchildren. The children and grandchildren aren't having any trouble finding employment, albeit sometimes it's hard to make ends meet because of, lofty interest rates, high prices, reduced credit availability. But still, those two factors, stocks, jobs, are really propelling this market ahead. Folks think that if Trump and the Republicans get control of Washington, that there's going to be more enthusiasm and an accelerating feature.
Although, ironically, if he is propelled to the White House, it will likely be a lot of voters who don't feel like the economy is working for them. But that's another. But we won't go too far down that. I'm curious what all this means for the Fed, and what you think the Fed is going to be doing at its next meeting. Given what Josh, it seems like you have what you see as a clear picture of the economy. Yeah. But given the sort of noisiness and messiness, what does that imply for the Fed?
Well, listen, I think the economy is doing terrific at this point. The 50 basis point reduction wasn't needed. It really added fuel to the fire. We got some of those.
Do you think that the inflation data that we're going to get this week is going to bear that out?
I think so. I think, the PC is a little bit stale because once we get CPI and PPI, we kind of, and a lot of it has been, really oil prices cratering, and that's been a huge determinant. We don't know how long that's going to last. A lot of global factors, in Europe and Japan and China, they're not doing nearly as well as us, in terms of economics for that reason. And with the long end jumping so much, right, this is a significant occurrence, Julie. It's not often that the Fed cuts and then the 10-year yield jumps 70 bips. Right. You had to see the realtors and the car dealership folks and the furniture showroom people, they were calling me frantically because they're seeing on the headlines, Fed cuts 50 basis points, but they're looking at the borrowing costs that they're working on their screens going up. They're like, Torres, what's going on? And then all of a sudden, they're going from becoming realtors and salespeople to becoming yield curve analysts.
Right. Well, luckily they can call you and say, Torres, what's going on? And you're there to tell them, Jose. And thankfully you're here to tell us too. Appreciate it.
Always a pleasure. Thank you.
We're just getting started here on Market Domination. Coming up, earnings season's in full swing. After the closing bell, we got a loaded slate of reports crossing the wire. We'll get you the latest numbers and analyst reaction from the likes of Alphabet, AMD, Chipotle, and more. Stick around. More Market Domination still to come. Now time for some of today's top trending tickers. You can scan the QR code below to check out the best and worst and most watched stocks of the session on Yahoo Finance's trending tickers page. First up, the top trending ticker today, as we told you earlier, is indeed Bitcoin after it passed the $73,000 mark. Yahoo Finance's Jared Blickery joining us here to break down the latest action. We have not seen that number in quite a while.
That's right, Julie. On some exchanges, they're talking about record highs. I don't think we have it just yet, but we are very close. And here's Bitcoin up 5.29%. I will show you a chart for the day, and we've seen some acceleration over the last few hours here. And let me just show you where it is in relation to where it's been earlier this year. As you can see, it's been going sideways mostly, still up 66%, but we are now finally back at this point that we were just reaching back in March. And so it's just been a long, long consolidation. We got a little bit excited, at least I did, when we broke through this negative trend channel. But I said, given the number of false breakouts that we've seen with Bitcoin before, we got to give this a little bit of room to run. And even now, you do want to see it sustain the breakout for a little bit. But as soon as you move beyond that, I think traders are already looking to 100,000, 125,000, and you can imagine how it's Bitcoin. So the targets go up from there. But I wanted to show you the price action in the entire crypto complex over the last 5 days. Real quickly, the leader is Dogecoin, and there's lots of interesting memes and tweets and posts about Elon Musk and Dogecoin once again. This is a year-to-date look, and you can see Dogecoin not quite back up to its earlier highs of the year, but over the last month, it has been on a blistering tear here of 40%, and just goes to show you that the joke coin, when the joke coin is in play here, usually means that there's something interesting happening to Bitcoin, which it is.
Jared, thank you. Appreciate it. Taking a look now at Broadcom, as that company is reportedly working with OpenAI on a new AI chip. This is according to Reuters. So that is the headline, Julie, got attention. OpenAI working with Broadcom and TSMC build its first in-house chip designed to support AI system. This is per Reuters, citing sources. Also says OpenAI has dropped plans for now to build this network of foundries due to cost and time. So now it's going to focus on in-house chip design. Broadcom up today and adding to what has been just a remarkable run for Hock Tan's company.
Definitely. There had been some reporting previously that OpenAI was working on some sort of effort to develop those chips. AMD and NVIDIA reportedly had been potentially partners in helping it build out its infrastructure already. But this is new here that TSMC might be involved and that Broadcom might be involved. And as you know, anything touched with the OpenAI magic wand these days seems to be getting a lift.
You know, I mean, big picture, you look at OpenAI and other AI services, they just need, I mean, they need so much computing power. And obviously everybody's turning to Jensen and the team at NVIDIA, but they would prefer other options. And listen, if you have the engineering talent and the money, you would try an in-house version.
Yeah, and there's also talk about the migration from training to inference, right? The inference being the sort of second phase of AI training. Turning now to B. Riley, those shares are surging after the company is making a move to pay down debt. B. Riley Financial collecting $236 million. It is selling branded assets. Now, this is the second sale that it has made of branded assets. This sale includes some of the consumer brands that people might have heard of: Hurley, English Laundry, the Limited to BB as well, Brookstone. So it's selling them in different pieces here. B. Riley has had a tough go of it, to say the least here. The company has been investigated. It's had delayed financials. The stock is down almost 70% this year. So it's just trying to sort of dig itself out of this hole.
Yeah, it could help the company in its balance sheet. Debt load on this one is about $2 billion at mid-year per Bloomberg. You know, remember, I think we talked about this. The company suspended its dividend, I remember back in August. So really kind of prioritizing cutting leverage, but as you noted, this one has just been clobbered, which we've discussed.
One more quick note, it is heavily, heavily shorted. So when you see a pop like we're seeing today on this bid to raise some money to pay down debt, short squeeze probably part of the equation.
All right, finally, let's take a look at now shares of Crocs as the company expects 2024 sales growth on the low end of its prior guidance. Look at that, we're down almost 20% in today's trade. So let's get the numbers here. It sounds like the issue here, Julie, was the casual sneaker and loafer brand, Hey Dude. That sounds like the issue. The CEO saying Hey Dude's recent performance and the current operating environment are signaling it will take longer than we had initially planned for the brand to turn a corner, and you can see investors reacting.
Yeah, Hey Dude is about 20% of the company's sales here, so it's relatively small, but it looks like that the company is predicting for the year that Hey Dude sales will fall about 14.5%. Crocs is predicted to grow about 8%. So that's kind of the equation that gets it to this lower full-year forecast than some in the street were expecting here. So it seems like Hey Dude is the issue. It looks like that this is the worst reaction to an earnings report going all the way back to the second quarter of 2016 for Crocs. So interesting. It's been a while since we've seen this.
You heard these reports of schools banning Crocs, safety concerns, distractions. Yeah, and it's fast. Actually, I texted the wife, my 5-year-old, kindergarten, they're fine with the Crocs. The preschool banned them. They were anti-Croc.
Well, they were worried about injuries. Remember Heelys?
Yeah.
The ones that had the wheels on the bottom of the shoes, and they got banned from schools, and that kind of killed that brand. But Crocs probably a little more entrenched.
I did see Crocs saying they thought those restrictions were baffling, I believe is reportedly the word I heard.
Yeah.
All right, Cisco's 2024 Partners Summit is underway this week. Company unveiling a new suite of products to compete in the AI landscape. And Yahoo Finance executive editor Brian Sozzi spoke with Cisco CEO Chuck Robbins about the new announcements earlier. Take a listen.
We've taken the opportunity here to start what is really a rolling thunder of announcements around AI infrastructure. Most of our enterprise customers are focused on modernizing their underlying technology infrastructure right now to prepare for AI applications. And some of the announcements we're making this week, which you mentioned, there's a UCS platform that has GPUs in it for customers that just need GPU compute cycles. And it's a necessary technology that our customers are really interested in. And then there's also AI pods, which would be, we've done these historically with storage partners where we would include compute with storage and really give our customers an integrated managed platform. And we've called those different types of pods over the years based on which storage partners we've been working with. So we're announcing obviously these AI pods, which will have AI GPUs in them serving the same purpose, which is just a combined, consolidated piece infrastructure stack for our customers in the enterprise. So we're pretty excited about it. It's, again, we've got months and months and months of these announcements that are going to be coming out. The teams have a great roadmap, and I'm really proud of what they've accomplished.
I liked how you put that, a rolling thunder. Now that you're Cisco, I think networking, I think infrastructure. When you talk to some of the folks in the enterprise domain, what are some of the challenges they're having in deploying some of this AI?
Well, Brian, it's early right now, but it's very clear that in Q4, our Q4, which ended the end of July, we saw customers actually taking funds that they had set aside for AI and making the determination that it's as important to update their infrastructure, update their network infrastructure, their security infrastructure in order to be ready for these AI applications. In some cases, customers said, I don't even know what those AI applications are going to look like, but I know I need to modernize my infrastructure. So we're starting to see that happen. And then we are starting to see really interesting use cases in the enterprise where these AI apps are being built to do inference against the foundational models that are largely running, obviously, in the cloud infrastructure, and then some of the custom models that some of these customers are running on-prem. So we're in the early stages, but it's really a return to our core relative to what our customers need, which is real high-performance infrastructure with security to actually be ready for these AI applications.
As we look towards 2025, Chuck, this year, I think in AI, everybody's just out there trying to, I guess, just get ahead in AI and roll out these new models. What do you think 2025 will be known for? What are some of the key trends you're seeing?
I think 2025 is going to be the year of the enterprise application. I think they really are. I think we've seen this focus on the training models that are out there, and ChatGPT and Anthropic and all these that are out there, where you got Claude, you got all these models that people are using. And I think now the enterprises are really figuring out what are the use cases that we can deploy, again, using models trained on my custom data combined with these foundational models. Those two things together are giving our customers great insights and actually capabilities to engage with their customers in ways that they haven't been able to before, or to predict what their customer behavior is going to be, or to predict when they may have a failure in an industrial component of an oil and gas pipeline. So I think 25 is when we're really going to see these applications start to come to life.
Whoever wins the election, Chuck, will have obviously somebody new in the White House next year. From a business perspective, what would make business easier for Cisco? What could that administration do to make Cisco even more prosperous, even more innovative?
Well, Brian, I think you know what business wants. Business wants predictability. Business wants consistency. Business wants less regulation. We want pro-growth policies. We want pro-growth tax policies. We want pro-growth trade policies. And I think whoever's in the White House, if we can focus on those things, in addition to all the things that are really important for the country right now, like really getting comprehensive immigration taken care of, and that includes really comprehensive. I mean, it's every aspect of it. I think that all those things are important to business, and I think that depending on which candidate wins, I think there's different aspects of that. There's a different subset of each of those that we probably work on with the administration, but there are areas of common ground that we can find with both. And I think much like you, we're anxious to get past this election and move forward.
Nuclear becoming a busy industry fueled by intense demand from the AI boom. We're seeing investments across big tech. Microsoft announcing a deal last month with Constellation Energy to reopen 3 Mile Island and a reactor there. Amazon and Google also getting into the space a couple weeks ago, forming partnerships with X Energy and Kairos Power, respectively. And then there's Oklo. It's a Sam Altman-backed nuclear company that's had a strong run over the last month. It's publicly traded. It's up over 150%. The company already has ties with the Department of Energy to try to prep a new plant in Idaho. And joining us now to talk more about the nuclear space is Oklo CEO Jake DeWitt. Jake, thanks for being here. We've been trying to wrap our arms around all of this as we see this sort of nuclear resurgence here in the U.S. And we've been talking a lot about small modular reactors, right, which is this new innovation you guys are also working on. Can you just explain to viewers what is different about SMRs from traditional nuclear reactors, is it mostly the size, or is there something else to really focus on here as well?
Yeah, thanks for having me. Excited to be here. There's a couple ways to kind of differentiate it. Size is one big factor, which comes with significant benefits. It allows for a lot more scalability, a lot more capital efficiency, which are big attributes. But also, what you're seeing happen, and like what we're doing, is bringing forward some of these next generation technologies that just have certain inherent upsides to them, thanks to sort of the innate benefits they offer. And what that means is they look different than today's plants. They don't use high pressure water as a coolant. Instead, we use liquid metal that operates at atmospheric pressures. It's compatible with common alloys. It allows you to sort of have a clear path to scalability. It opens the door to do really cool things like nuclear waste recycling. So all those things are what we view as sort of the next generation of nuclear technology coming forward. Some of which, like ours, are very mature technologies, right? We've had experience as a society building and operating a lot of these plants, and so it brings forward just a different combination of attributes from cost effectiveness, from scalability, as well as what they're delivering in terms of both the combined heat and power product to open the door for a lot of different use cases. Obviously, on data centers, there's a lot of excitement on the electric side. Right. There's also actually interest on the heat side because you can drive some cooling with the heat product, which is kind of weird, but one of the things you can do.
Jake, I want to zero in on the recycled fuel that you guys want to use in your reactors. How does that work? Because isn't nuclear waste, isn't it spent? Isn't it used up? How do you still get some juice out of it?
Yeah, this is why I fell in love with nuclear as a kid. When you split an atom, you get almost 50 million times more energy than when you combust like a molecule of natural gas or so. It's incredible. What that means then is there's a lot of energy in nuclear fuel, and actually in almost all reactors, you only use about 5% of the fuel in one pass through the reactor. And there's reasons why. Long story short is, you could put more fuel in, it could run for longer, but that comes at increased cost for the added systems you would need to manage all of that. So it's kind of where the optimum lives. That means that more than 90% of the fuel remains unused coming out of the reactor. Now, that said, it's not equally usable by all types of reactors, but by fast neutron reactors like what we're developing, and a few others are developing, that's a technology that can actually use that material and keep reusing it until you use pretty much all the energy content that's available in that fuel. So you'll keep recycling it a bunch of times and get that remaining energy out. Just to put a number on it, what's cool about that is, and today in the U.S., there's something on the order of about 90,000 metric tons of used fuel around the country. That sounds like a big number, but it's pretty dense stuff. It would fit in something the volume about the size of a super Walmart. But there's enough energy content remaining. In other words, there's enough unused fuel there to power the entire country using what we're doing for over 150 years. And every year, the current plants are producing enough waste to power the country for 4 more years. So a pretty exciting opportunity to sort of deconstrain nuclear growth as we think on sort of the longer term outlook, but also reduce fuel costs with the added benefit of sort of changing the waste profile.
We're talking about the technology, Jake. Also walk me through your business model. How does that kind of compare and contrast with rivals? And who are your customers, Jake?
Yeah, so we were one of the first to announce a partnership, kind of a major partnership with a data center provider. We actually have 2 that we've announced publicly. We've got a 500 megawatt partnership agreement with Equinix that included some prepayment, as well as a 100 megawatt partnership with a data center development in Wyoming. Obviously, we have some exciting insights into the world of what's going on in AI, given who the chairman of our board has been since pretty much the beginning of the company, Sam Altman. But that said, one of the things that we set out to do in the beginning was make it easier to buy what people really want from nuclear systems. In other words, make it easier to buy nuclear power, because the clean, reliable, affordable power, that's the stuff people really want. And so the typical business model has made that real clunky. It's really chunky in its transactional process, and it's difficult. And we're unique because we actually make that easy we design, we own, we operate the plants, we contract someone to build them, and then we just sell the power out to the customers through offtake agreements. That makes it easy for them to buy what they want. It's great for us because we get recurring cash flows. And right now we're the only ones doing that without having to have a middleman in the business. So it really works well for scaling.
Yeah, sorry, Jake, to interrupt. Just to be clear, you don't do any of this right now, right? All of this is in the future. All of your competitors, what you're working on, is all in the future. And so, we've been trying to make it clear to investors, when you invest in this, it's a long-term thing. There's one analyst who likened it to biotechs, that it's sort of early stage. It may pay off big. But what are the risks here? I mean, there are regulatory risks. Are you sure the science works? Considering that you haven't been able to build one of these things yet, and neither of your competitors. So how do you know that, what degree of confidence do you have that it's all going to actually work, especially on the timeline that you're working on?
Yeah, well, design choices and technology choices matter a lot to that for managing that risk. Because yeah, certain design approaches have a lot of new things that haven't been demonstrated and proven, and are going to take a lot of work to kind of prove those out. We, on purpose, are building off a technology set that, cumulatively around the world, was something that was prioritized as a research and development program around the world in a couple different countries, and there's been almost 500 combined reactor years of experience garnered with these kinds of systems. And notably, in the U.S., we built two very successful, what I would call, demonstrations of this technology. So liquid sodium cooled fast reactors, one in Washington State, one in Idaho. And the one in Idaho, we pretty directly build off of. That plant was a 20 megawatt electric, just under 20 megawatt electric power plant, ran for 30 years, demonstrated some amazing characteristics and operating capacity, like operating characteristics, demonstrated the ability to recycle fuel, all those kinds of things. So not only do we know the science works, we know how to build these things, we know how to operate these things. And that's what we're intentionally building off of and building very close to in proximity. Because our view is, look, we know how to split atoms and control the heat and manage it. It's just about what are the sort of most favorable combinations of approaches that have technical maturity around them so you can go quickly to market. And that's a focus of ours, is not trying to push the edge. You don't need to. It's been done before. We know how this works. So then it's about kind of modernizing that design approach with modern supply chain characteristics, get stuff built more quickly, accordingly on that. So that kind of gives us an advantage on sort of the technical side. But to your question on risk, yeah, there's regulatory timeline risks. We were very excited to see the ADVANCE Act passed through Congress and signed into law by President Biden that points to continued regulatory reform that builds on legislative work that was passed under the Trump administration as well. So that's all been helping move the regulatory process along. But that has implications on potential timeline risk, and there's certain supply chain risk around fuel. But also we're seeing the government put a lot of money to help on the fuel supply chain. But you're right, like we're not going to be producing power until 2027. Nobody else is going to be before that. Everyone's going to be kind of longer term. So it takes some time, but a lot of these technologies are building on things that have been done to some degree before, and in our case, very much so. So that kind of takes some of those risk factors and puts them in a different direction, if that makes sense.
Jake, it's great to have you on the show today. Thanks so much for your time. Appreciate it.
Thanks for having me.
F5 network shares, they are soaring today. That's after the company reported an earnings beat and record revenue in its fourth quarter. Its board of directors also authorizing a new $1 billion share buyback program. And joining us now to discuss those results is Francois Locoh, the new F5 CEO. Francois, it is always good to see you. So you reported solid results here, Francois. Top and bottom line beats. Looks like software continues to outperform. Investors certainly like what they see. Stocks up about 10% in today's trade. But walk us through the quarter. What are you seeing in the business, Francois?
Well, thank you, Josh. As you said, it was a record quarter, both for the quarter and for the fiscal year, where we beat on the top and bottom line and also raised our guidance, both for the first quarter of 2025 as well as for the full year. What we're really seeing in the business, Josh, is we have successfully redefined the role of F5 beyond the data center and have transformed the company from a company that was very hardware-centric and was essentially a single product company into a software and security leader. And we're seeing that in the metrics in the business. So if you look at product revenue today, over 58% of our product revenue this quarter was software. Up from 13% if you go back several years ago. The software is growing. We had strong growth in our software this quarter, 19% growth, and over double-digit growth in software for the full year. And what's most pleasing to us is not just the growth we're seeing in software, but the predictability of that growth is improving because more and more of our software business is coming from existing customers, if you will. And so, 2 years ago, 50% of the software revenue that we did come from business that existed at the start of the year. This year it was 60%, and we're projecting that for next year, over 2/3 of our software revenue will come from business that we already had at the start of the year. So the renewals and expansions, the benefit that we're seeing from having created a strong subscription model is really changing the pace of software growth at the company, and we're very pleased with that.
Hey, Francois, it's Julie. So when you look at that growth trajectory for software and you talk about the predictability improving, tell us about 2025 then, and what you expect for that and also the balance with the other parts of the business.
So we raised the guidance for 2025 on software to upper single-digit growth from a starting point that's way higher than we thought it would be only a year ago. And that's coming in part because of what we're seeing. What we're seeing is customers that have signed subscription agreements with F5, because we have removed the friction that existed in them being able to add new products and new services to these subscription agreements, we're seeing very strong growth inside of these subscription agreements. And that's what's driving our confidence in growth for the year. And over the last 3 years, we have really invested significantly in the portfolio to add not just networking, but security capabilities. We have built a full security stack for application security. And we're seeing a lot of customers that had purchased point solutions over time that have ended up with too many vendors and too many point solutions looking to consolidate. And they are able to consolidate on F5 because we chose a model that supports hardware, software, and software as a service. And we're very unique in the industry in our ability to support all three consumption models for our customers.
Francois, we talk a lot, as you know, about the mega trend of AI on this show. I am curious, how's F5 positioned to leverage and take advantage of that technology?
Well, we are emerging, Josh, as an indispensable player in AI. And it turns out, if you look at the core expertise of F5, our expertise is really in managing and securing and optimizing critical network and application traffic. And we have developed that expertise and intellectual property over the last 25 years. Well, it turns out that AI workloads that are very complex and move huge amounts of data between AI applications and storage tiers, or between storage tiers and AI factories. Well, those AI workloads need exactly the same expertise in traffic management and security that F5 has developed over the last 25 years. And so we're seeing opportunities both in hardware and in software to apply that expertise to AI environments.
Francois, always good to see you and to have you on the show. Thanks for joining us.
Thank you.
And coming up, we're taking a look at the best ways to be positioned in the healthcare sector with today's Investor Playbook. Stick around, much more market domination still to come. Pfizer delivering third quarter results above the street's expectations amid activist investor pressure. Company also raising its full year guidance by $1.5 billion. Now Finance's Anjali Kamlani joins us now with more. Anj, it sounds like a solid report, but the stock is edging lower here.
I know, and there's reasons behind that. So we know that Pfizer has struggled to kind of come back from the COVID story, right? It's COVID products really taking the focus, and the waning of the demand there being the story that investors have focused on. And so what Pfizer did do, of course, with its upgraded guidance, but also with a surprise boost from Paxlovid, that's a COVID-19 treatment. That's where the CEO was kind of focusing his strength on the earnings for this quarter, but it seems like investors are still waiting for more. So here's a little bit about what CEO Albert Bourla told me he sees as the positives of the quarter.
We beat on top line by 20%, almost 18. And we beat the bottom line by 70%. And we beat on COVID business, and we beat on non-COVID business that had a phenomenal growth of 14%, the non-COVID business. But also, even more importantly, we beat almost on all new products.
And those new products are the things that are struggling to really break through to the investor crowd. Stuff like Padcev, which is from that Seagen, that $43 billion acquisition that the company went through, is really still struggling to capture attention. And we know that we will not see the types of revenues from those drugs anytime soon. And that seems to be the focus of what kind of spurred this activist investor battle with Starboard Value, Pfizer's CEO, meeting with them last week. But we hadn't heard much since then. I asked Bourla about this, and here's what he had to say about what was asked.
He said that the money of COVID were invested not in a good way. And I think that the acquisitions that we did, Seagen, is transformational for Pfizer. BioNTech deal, transformational for Pfizer. The Biohaven and the Seagen and BioNTech, they are more than 80% of the total capital that we invested. And all three are performing at or better than what we were forecasted.
So that's part of the story. The other part is that Bourla did say that he agreed with the idea that Starboard came with the idea that there should be some changes, there need to be some changes, but he criticized a little bit, saying that they came too late to the table, that there have already been moves made, like cuts that are supposed to save the company about $4 billion. There's also the idea that some of these pipeline products are going to bring revenue, and there's also the idea that the COVID business is not going away. It's still going to be part of the regular business and folded in, and a good source of continued revenue. So the story for Pfizer is wait and see, and Starboard didn't have any new ideas to offer, Albert told me.
According to him. All right, we'll see how that plays out. Thanks a lot, Anj. Appreciate it. Sticking with healthcare, it is indeed a big week for pharma. Some of the biggest players are reporting their quarterly results this week, including Pfizer, surpassing those Wall Street expectations and lifting its full-year guidance. But our next guest says smaller healthcare companies with more experimental offerings are an attractive space for investors. Stacy Sears is Emerald Advisors portfolio manager of the Emerald Growth Fund, and she's here now with more. Thanks for coming in.
Yeah, thank you for having me.
So we just heard a little bit about one example, at least, of a big pharma company and kind of what it's up against. But many of them are up against this whole patent cliff situation, trying to build up this pipeline. So you say look on the other side. Look at the companies that are maybe the source of that pipeline.
Absolutely. We have seen a tremendous amount of innovation within the healthcare industry over the better part of our 20 to 30 years that we've been investing in that space, really catalyzed by the decoding of the genome in 2003, which identified over 8,000 genetic diseases. It was at that point in time we had the map, we had the key, and we saw innovation accelerate, and small caps have been a big part of that acceleration. So if you think about advancements in DNA editing, advancements in RNA editing, which are ongoing as we sit here today, and broader pursuit of orphan and rare diseases. That decoding of the genome has really enabled that, and small caps have been a big player in that. As a matter of fact, just if you take a look at 2023, approximately 2/3 of clinical trials were started by companies in the small and emerging biotechnology space, and approximately 56% of the new drug substances approved in 2023 originated within small and emerging biotechnology companies.
How would you characterize just broadly, Stacy, valuations, this sector?
I think that's an interesting question. I mean, valuation has always been more challenging within the healthcare area, but I would say what is now a tailwind is that the sector has been underperforming over the last couple years. I think very much an inverse performance correlation to what we were seeing with interest rates and yields. So the fact that we're starting to see that move back in our favor, clinical advancement has really continued unabated, and we're looking now at a pipeline. I think you mentioned it. You know, we have large cap pharmaceutical companies that have close to a $300 billion patent cliff as those drugs move generic by the end of this decade. Historically, they've filled that pipeline with research being done within small cap companies. So we see an M&A tailwind in the area as well that could be emerging.
So you're looking at a few names that you think might be targets potentially. One of them is a company called Insmed, which actually has a drug to market.
Correct.
Is my understanding, to treat lung cancer in patients that haven't, where other treatments haven't worked. Am I understanding that right?
What they have on the market today is a drug by the name of Arikayce. It's actually an inhaled antibiotic.
Okay.
For lung infections.
Okay, so not lung cancer, pardon me, lung infections.
Correct, which is about a $300+ million a year revenue business for them today. But what we're excited about was the recently released data, phase 3 data that happened earlier this year in a disease state called bronchiectasis. And what that is basically an inflammatory lung disease, which causes a significant amount of exacerbations, which essentially is a heart attack for the lungs, which over the long term can create a diminished lung function. So with the introduction of this phase 3 data, company had very strong success across all of those metrics, and we believe in our conversations with practitioners that the market opportunity that the company laid out at about $5 billion is understated. The physicians have a very high intent to treat. There is an unmet need, and we believe that the application of the drug beyond diagnosed bronchiectasis patients is broader, that we could see application in COPD because bronchiectasis could be an underlying condition as well. So we think that $5 billion is a low target. Company will file its NDA at the end of this year. We expect approval next year. And then they also have a very attractive pipeline they're working on in inhaled treprostinil for PH-ILD. And we think we're going to get data on that one as well.
What about, quickly, Stacy, Wave Life Sciences, which has already had a run?
It has had a run. The company in the last 3 months really has had 2 significant announcements as far as clinical progress. The first in Duchenne muscular dystrophy, where they are demonstrating dystrophin, that the body is generating dystrophin. So I should step back in that they are developing drugs based on RNA therapeutics. The second advancement, and this was the most significant value driver, was they announced results from their first in-human proof of concept trial for an RNA editing. So they're actually able to go in, they adjust your RNA so that if you were unable to produce a certain protein or overproducing a certain protein, that they can manipulate that outcome. And the great thing about RNA editing versus DNA editing is that it's not permanent. So you could actually dose that on a sub-Q basis monthly and bi-monthly. So we had their first trial results in trypsin deficiency, which is an accumulation of protein in the liver, which can lead to lung-related diseases. So very significant advancements, notable. They're leading the space. There's no one else that has had proof of concept in human data, and we're really excited about the opportunity. That program is partnered with GSK, but we believe in the upcoming Analyst Day that they're having here in this week, we're going to see company-specific additional targets that they're going to own 100% of. So we believe that there is still a lot more value to be had here in this very innovative life sciences company.
Stacy, appreciate your time and those picks. That was great.
Great. Thank you so much.
Thank you. All right, while we're wrapping up today's market domination, don't go anywhere because the earnings fun is about to begin. We've got you covered with all the action following the closing bell, including the latest reports from Alphabet, AMD, and many more. Stay tuned for Market Domination Overtime.
Are you a passionate investing bull? Maybe you love scooping up shares of NVIDIA on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at Second in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
There's the closing bell on Wall Street, and now it is Market Domination Overtime. We are watching to see if we are perhaps getting a record close for the Nasdaq Composite today. Looks like we got it. The Nasdaq leading this session higher in terms of the benchmarks, up 0.75% and closing the day at 18,712. I believe that is a new closing high for the composite. I'm sure that Mr. Blickery is going to check that for me in a moment. But in the meantime, yes, we are seeing that big gain there. The S&P 500 also rising on the session, just about 1/3%. The Dow pulling back a little more than 150, or about 1/3%. A lot of earnings-related moves here, but the powering higher of the Nasdaq coming as we are about to get earnings from Alphabet and AMD. Jared's got a closer look at it all. Hey, Jared.
Hey there. Well, let's take a look at the Dow first. So we ended a little bit down, and this is kind of a mixed day, and we've seen this a lot lately, changing leadership. Here's the Nasdaq up 0.8%, and the S&P 500 somewhat in between, up 16 basis points. And I'll also add the Russell 2000 into the mix, down about 45 basis points. And let's take a look at the 10-year. That has been screaming higher recently, although it is just barely negative on the day. So it was into the 4.3, 4.35 range very recently. It has rejected that, so I think that's notable as higher yields had been placing somewhat of a headwind against stocks. And here's a sector action for today. You're going to see it was mostly about the megacaps, tech and communication services. Each of those up about, well, tech was up a little more than 1%. Communication services a little bit less than 1%. Utilities taking it on the chin. That was down about 2.12%. If we take a look inside the Nasdaq here, we see the megacap action and the outperformance. Meta up 2.6%. Broadcom up 4%. And I'm going to send it back to you guys here.
Thank you, Jared. Record day for the Nasdaq, the tech-heavy index closing at a new high as investors wait on earnings from some of the biggest names in the industry. But our next guest says the event shaping markets the most recently is the election. And joining us now is Tim Chubb, Girard, Chief Investment Officer. Tim, we'll get to the election, but first of all, we do have big tech on deck. Alphabet's about to report. Tim, I'm curious, so far during this earnings season, give me your take. What have been your big takeaways?
Yeah, sure. And thanks for having me. I'd say more than anything else, feeling about just really lukewarm. We had seen, a number of earnings revisions, coming into this season, particularly with a lot of the consumer companies that have seen pricing softness as consumer tastes and preferences have definitely changed as a result of, just the high level of prices and inflation that we've been combating with for the last several years. And so overall, I'd say, so far so good. But it was a lower bar coming into earnings season. And to your point, I think it's going to be all eyes on the Magnificent Seven. As we kind of get into next year, last quarter, we saw a lot of scrutiny related to just what that incremental AI revenue may look like and kind of what the glide path may ultimately mean for some of these companies who have been investing so heavily in their AI transition over the better part of the last 2 years. And so, headed into 2025, looking at some of these earnings growth estimates, I think overall, they're relatively overstated, just given how much of a deceleration that we're actually going to see in capex related to AI, moving from sort of that 40 to 60% range in 2024 down to that 10 to 30% range, which has been a huge driver for not just expectations for last year, but earnings growth this past year.
And so, Tim, put it all together for us. What are you doing strategically right now?
Yeah, gosh, right now we're really have taken the last couple months and repositioned our portfolios, kind of shifting into neutral. I think there's large sort of when we have an election that's as divided and controversial as we're currently I guess going about to experience next week. I think it's important just to take a step back. Focus on the fundamentals, be selective. I mean, this has definitely been a great quarter from a stock picker standpoint, given the beats that we've seen have been rewarded really favorably, more so than prior quarters. And so we're relatively neutral, across our equity strategy, really focused on, sort of balancing some of the underappreciated cyclicals, like, banks and financials potentially, which certainly have, seen a run up here in anticipation and repricing that we've seen. From a sort of a divided government and a Harris win to now a non-zero probability of, certainly going to be, a little bit more of a different composition within Congress and potentially within the White House as well. And within fixed income, it's largely taking profits. I think corporate balance sheets are, really in great shape. But as top line slows and we start to see sort of the refinancing environment that we've been in, a lot of these companies have had debt that's set to mature in the next year or two, or in some cases just recently. And that's ultimately going to put pressure on profit margins as well. So it's a little bit of a double-edged sword for small caps.
Tim, we got to leave it a little bit short today because we got Alphabet we got to get to. Thank you so much. Appreciate it.
Absolutely.
Good to see you. Indeed, let's get to those Alphabet third quarter results, and it looks like they are coming in largely ahead of estimates. Third quarter earnings per share, $2.12 versus the $1.84 that analysts had anticipated here. Revenue ex-TAC, ex-traffic acquisition costs, which is how we measure it, about $74.5 billion, $72.9 billion is what analysts had been anticipating. So beating on that front, and big beat on the Google Cloud revenue front as well, $11.35 billion, $10.79 billion is what had been anticipated. It looks like YouTube ad revenue also beat analyst estimates, as well as overall ad revenue for the Google unit itself, Josh.
Yeah, it looks like just beats all over this print, Julian. So no surprise, the stock is higher here by about 2%. CEO Sundar Pichai saying his statement here. He talks about the momentum across the company. He calls extraordinary. He talks about the commitment to innovation, as well as he says our long-term focus and investment in AI are paying off. He says with consumers and partners benefiting from our AI tools. Lots of questions, of course, off the call. I think we're going to, more color on ad spending trends. I mean, analysts do, emphasize ad comps do get tougher for this name in the second half, but how exactly executives characterize just the digital ad spend environment will be really critical. I think the AI evolution in search, Julie, is going to come up on this call, and how they think about that. Google Cloud beats estimates. That is notable. The third largest cloud player now in this market. Of course, you're waiting to hear still from Amazon and Microsoft, and they have been investing there in tech, in sales. How much of a meaningful contributor is AI to the business as well? That'll surely come up on the call.
Yeah, I was just doing a little math here. It looks like the YouTube ad revenue went up by about 12%, if my math is correct, which is always a caveat. And I know that, even though the stock had been running up into this print, the analyst commentary ahead of this report, even from people who were bulls, was not terribly enthusiastic. I mean, even the likes of Dan Ives, who, as we know, is a bull on the name, said that there was limited opportunity for upside relative to estimates this quarter because he had seen some mixed feedback in, for example, an advertising survey they had done. Also, another bull, Justin Post over at Bank of America, said, we'll have a meet or beat in the third quarter. Search is stable. YouTube could be weak. So it seems like, again, even though the stock action had been higher, kind of the chatter around it was not that enthusiastic. So it's interesting to see these beats and to see the company, the shares rise. Again, to your point, what they have to say on the call more color around the AI story, I think is going to be quite interesting.
Yeah, I mean, to your point, I agree, Julie. I think even when you would read through the previews, the notes, even of folks who were bulled up, you did sometimes pick up some hesitancy there. And there's, I mean, listen, there is, and we've talked about this, the AI evolution in search. There's open questions long-term, what that means for this name going forward. I think, you also more near-term, how they're thinking about fighting regulatory antitrust challenges. That's going to come up on the call. You do have some change in the C-suite that are notable too. Remember, you have a new CFO here, Anat Ashkenazi. This is her first earnings, actually. Came over from Eli Lilly. I know what's interesting is some analysts bring up how she did used to provide some annual guidance when she was at Eli Lilly, and so some on the street are wondering, does that mean any change to Alphabet's sort of guidance approach going forward? Could be something to watch.
One more thing that we are going to be listening closely for. Spending, right? Is there? It doesn't. I haven't been able to glean from the release if we've gotten any clarity on any changes to spending plans, capital spending related to AI infrastructure. We know that the hyperscalers like Alphabet have been spending like crazy, so maybe we'll get a little more commentary about that on the call as well.
Yep.
All right, well, let's talk more about all of this. CFRA Research Senior Equity Analyst Angelo Zeno is standing by to join us with more on Alphabet's third quarter. So first of all, just give us your big picture, top line reaction here, Angelo.
Yep, so thanks for having me. I guess, overall, I mean, you guys kind of, did a good synopsis of it, but overall, the numbers were good. Revenue, I believe, grew 15%. Earnings was $2.12. That would kind of, beat the expectations out there. I think revenue Street was looking at for about 12% growth, EPS of about $1.85. They don't provide kind of guidance in the press release, so we'll kind of wait for some qualitative data, on the call out there. But overall, initial reaction is good results. I think kind of you pointed towards the Google cloud side of things, and that's really kind of where there was a really nice beat from where our expectations were. And I think even kind of when you look on the Google Cloud side of things, in terms of the margins, their operating margin was about 17% or so is what I have. And that is by far the highest operating margin that they've ever posted on the cloud side of things. The prior quarter was 11%. The prior quarter before that was about 9%. So they're executing extremely well on the cloud side of things in terms of the operating margin. And the overall margins kind of held up where we expected. I would say kind of, I know you kind of alluded to the kind of the expense side of things. If you kind of look, based on what they spent, at least this quarter in terms of, equipment, it was about $13 billion. Kind of our expectation was, they need to keep it in that $12 to $13 billion quarterly run rate, which is kind of what the company had been alluding to here over the last couple of quarters and kind of going through the rest of this year. That's what they kind of kept it at. So that's definitely a good sign out there in terms of kind of the spending levels that we saw here this quarter, which is probably helping the stock kind of move higher here.
What about the AI evolution in search, Angelo? How you think about that, what that means for this name, not just near term, but as you try to map out what it can also mean long term?
Yeah, I mean, listen, that is the biggest question out there for Alphabet, and I think it's why a number of individuals out there have kind of been hesitant on the Alphabet story here. And the way I look at it is, we're believers of Alphabet and kind of how they've evolved their business over the years and over the last 2 decades, and this is definitely going to be a trying time for them, and they're going to have to figure it out and kind of really innovate quickly. But what we've seen thus far in terms of how they're innovating on the AI overview side of things, and we definitely want to hear kind of what they're seeing in terms of the monetization side of things. As far as that is concerned, on the call, we expect them to fully talk about that. But thus far, I mean, I'd say we're pretty encouraged with how they're kind of adapting to things here. Clearly, the competitive pressures are going to intensify here over the next couple of years, not only from the Microsoft's OpenAIs of the world, but kind of saw some news on Meta as well. There are going to be different ways people are going to search here over the next couple of years. But that said, we think Google is going to be they're going to be able to figure this out, and we think they're well positioned.
In the release, Pichai also highlighting YouTube and that total ads and subscription revenue there up surpassing $50 billion over the prior 4 quarters for the first time. I mean, I feel like a broken record every quarter because I always kind of say, is YouTube sort of the hidden gem within, but it's not hidden anymore, I guess, if we keep saying that, Angelo. How important, though, is YouTube for Alphabet overall? And kind of what's the interplay with the other businesses as well?
It's important. I think it's a very important business for them. It's growing very nicely. It was probably the business segment that really disappointed most in the second quarter. It actually kind of exceeded our expectations here in the third quarter, not only on the ad side of things, but on the subscription side of things as well. And it also, provides some nice diversification for them outside of the search side of things. So it is a critical part of their business. It's important. That clearly the investments that they're making on the AI side of things and across other aspects of their business, they can kind of trickle here on the YouTube side of things as well. So, for a number of reasons, because it is a good growth story, because we're kind of big believers on the whole kind of shift towards the connected TV market and kind of the advertising opportunities on that side of things. And ultimately, the fact that it does provide that diversification, again, away from search a little bit, I think are all kind of key reasons why you have to like the YouTube story here within Alphabet.
Do you think, Angela, there is a new CFO here as well, and Anat Ashkenazi? I saw some of your colleagues on the street kind of wondered if that hire could mean a change to this company's guidance approach going forward. What do you think?
We'll see. I mean, it's possible. I don't expect it to change much, to be honest with you. At least not on this call. But Alphabet has kind of been among kind of the Mag 7 names has kind of provided the least amount of information out there in terms of forward-looking guidance to investors out there. So we'll see if that changes up here in terms of some of the commentary that they provide on the call here. We'll know shortly. But that said, listen, I don't think they're going to rock the boat too much here in terms of how they kind of have approached things here over the last couple of quarters. I think, personally, the one thing I'd love to see her do here, and it's not going to be on this call or likely over the next 3 months, is I'd love for them to kind of get a little bit more aggressive in terms of the capital allocation policy because of the amount of cash they have on hand out there. But that said, we'll kind of see what happens.
Angelo, how much of a cap on this company's stock price is the regulatory overhang?
It's a great question. When we kind of look at the stock here from a valuation perspective, right, I think this stock is trading now close to about 16 times our 2026 estimate, on a net cash basis or slightly under that, before the move that we've kind of seen here in the stock price. So when we kind of look at kind of other names out there, specifically at the Mag 7 names, and even when you look at maybe Meta specifically as maybe that's kind of the closest peer or name you would kind of look at relative to Alphabet, which is, trading, I think, north of 20 times our 2026 estimate. I would say that's kind of the deviation out there. I think the stock should easily be trading 20 to 25% higher once we get greater visibility kind of on the regulatory side of things for Meta. That said, you're probably not going to get any great visibility on that side of things here for a while, right? Next summer is probably when we start kind of getting some commentary from the courts out there on how they want to tackle or handle the or the remedies that they want to come out for based on kind of the outcome that they announced back in August. But that's going to get appealed no matter what from Alphabet. So this is going to play out in the courts for a couple of years. And, I think investors just need to start getting comfortable with that. But that said, listen, we were kind of going into these numbers among kind of the Mag 7 names. I think this is the one that I was kind of most confident about because of the hate kind of going into the numbers here, given the valuation and given some of those regulatory concerns out there. And our view is Alphabet will be able to, again, navigate kind of the storm here. I don't think some of the kind of the headwinds and negativity that you've seen out there from a lot of investors is necessarily going to come to fruition for Alphabet.
Angelo, call starts shortly. If you have the chance to ask executives any questions, what would be top of mind after reading through this print?
Yeah, listen, I think kind of, in our view, it's, what's the digital ad landscape going to kind of look like going into 2025? And they're not going to kind of highlight that or kind of their views on that side of things. There are clearly some tailwinds that they're getting here in the third quarter and likely going into the fourth quarter in terms of the election and some other moving parts out there. So tougher comps are going to, make the story a lot more difficult in 2025. And, the other thing we kind of do want to know is what are the opportunities and monetization potential here on the AI side of things? not only on the cloud side of things, but within the search side of things. Specifically, though, as far as cloud is concerned, I think the beat and raises on the cloud is much more important than on the search side of things, because the street kind of really is, they're big believers on the cloud side of things. You don't necessarily have some of the regulatory scrutiny on the cloud side of things the way you do on the search side of things. So the big reason, the fact that we did see the beat and raise here specifically on the cloud side of things, I think really kind of helps the story here.
Angelo, thank you. And stick around. We're going to hear from you later on as well.
All right, thanks.
AMD earnings just crossing the wire. For more, let's bring in Yahoo Finance's Akiko Fujita. Akiko.
Yeah, we are seeing shares of AMD reversing the gains we saw in the session today. You see seeing some steep declines in after hours here on the back of, a bit of mixed results, you could say. I mean, adjusted EPS, 92 cents a share, pretty much in line with what the street was expecting. It was a beat on revenue, coming in at $6.8 billion versus the $6.71 the street was expecting. Record data center segment revenue, a number we watch very closely here, coming in at $3.5 billion. AMD saying that was up 122% year on year. Revenue guidance, though, appears to be why we are seeing that stock reversing the gains that we saw in the session today. Lower than what the street was expecting. Lisa Su, though, talking about the strong demand out there, saying we delivered strong third quarter financial results with record revenue led by higher sales of EPYC, saying looking forward, we see significant growth opportunities across our data center, client, and embedded businesses driven by the insatiable demand for more compute. So the demand, Lisa Su saying, is insatiable, but certainly not enough when you think about where they are guiding in terms of where the street wanted. So certainly going to be looking for any additional commentary coming out of that earnings call. Of course, CapEx, a big focus there as well. And, guys, it just seems like the demand, or at least the expectation, certainly very high here, certainly not meeting that, at least when it comes to revenue guidance. But in the quarter, it was a beat, at least on revenue.
Yeah, investors, at least initially here, disappointed. Stocks down about 5% in the after hours. Thank you, Akiko. And while the earnings party, it is just getting started here. On the other side of the break, we've got the latest results from Chipotle, Visa, and Snap. Stick around, more market domination over time still to come.
Chipotle third quarter earnings crossing the wire moments ago. The company's adjusted earnings topping expectations, 27 cents. That's 2 pennies above what analysts have been predicting. Revenue, though, coming in just light of the estimate. And the company's comparable sales as well, which is a very closely watched metric for Chipotle. Same-store sales, they're missing expectations, up 6% versus the about 6.4% that analysts had predicted. Nick Satiana is with us now, Managing Director of Restaurant Equity Research at Wedbush Securities. Not a big miss on the comp sales side, but Nick, for Chipotle investors who are accustomed to, a regular cadence of beats, this is perhaps disappointing. What's going on here and what stands out to you?
Sure. Well, first, thanks for having me. I think the bar was 6.5, but I like to remind investors that quarter to date, July, they were tracking sub 6%. So 6% still means acceleration in the second part of the quarter, and they don't really talk about their sort of Q4 to date trends in the press release. So we'll hear about that on the earnings call, and I fully expect. Once we do, I think there will be a little bit of a sigh of relief.
Well, Nick, I'm curious, what do you think margins look like for this name looking ahead, just given labor and food costs where they're at?
Yeah, the forward margins were pretty much in line. And going forward, again, depends on the amount of pricing they take. I think, expectations are realistic going forward, particularly in Q4. Now, near term, there's a little bit of a higher COGS headwind because the mix of beef is higher because of the current LTO. And once that normalizes, we should probably be 50 to 100 basis points higher on a normalized basis. But that was expected. And, Q4 numbers, I think they're about right.
There was a lot of talk about brisket ahead of this report, Nick, and how popular this offering was. They brought it back. I guess we don't have a lot of insight yet before the call, but, how much do you think that something like a brisket was a driver of traffic, but maybe not enough of a driver of traffic?
Well, yeah, brisket was a driver. It did result in acceleration in the second half of the quarter. Now, it was going to be tough to drive too much of an acceleration because they were going over a very popular carne asada last year. But I think, expectations got a little ahead of themselves in the near term. I do think the quarter-to-date commentary is going to, address some of those fears. And I think the shares are actually going to be fine once management starts talking on the actual call.
Interim CEO Scott Boatwright, Nick, I'm curious, what do you make of him? Is the interim CEO, do you expect him to get the full-time permanent job? And what do you think his priorities should be here?
Yeah, I do think that he'll actually end up getting the full-time permanent job. He's been the chief operating officer for years now. He's responsible for he's as much responsible for Chipotle's turnaround, post their own food crisis, poisoning crisis, and so. I do fully expect him to get the full-time position. I think the priorities are going to be to continue to do exactly what they have done over the last few years. Again, he's been part of that, right? Many innovation, increase the relative value perception by, putting themselves in a position of pricing competition more in line with grocery. And I think over time, between many innovation and conservative pricing, they're going to continue to gain market share.
Nick, I'm also curious about the cadence of restaurant openings, which is it's a lot, right? They're going to open in calendar 2024, 285 to 315 new company-operated restaurants. Next year, they're targeting another 315 to 345. Does that cadence make sense to you? Is that what they should be doing?
It not only makes sense, I actually think it's overly conservative. I think they should be going even higher. The measure for unit growth to us is if you have transaction growth, which is an indication of excess demand, and then number two, if you have rising margins, which increases or lowers the payback period, increases the cash on cash returns. And so, their payback period at this point is less than 1 year. So every store you build, the amount of money you spend to build a store, you get it back in less than 1 year. So, absolutely, I think it's a great number. And if anything, if it were me, I would try to build even faster.
Got it. If Nick ruled the world, or ruled Chipotle at least. Thank you so much. Appreciate it. Good to see you.
Thanks for having me. Bye-bye.
Yet more earnings to get to. Visa out with fourth quarter results, which exceeded estimates on the top and bottom lines. A modest gain in the stock of about 1.5%. Simultaneously, we have a Wall Street Journal report about layoffs at the company, although they did not confirm that in their statement. But again, the Wall Street Journal saying the Visa plans to lay off around 1,400 employees and contractors by the end of the year. Now, as for the Visa numbers themselves here, you see 271 is what they reported on an adjusted basis versus the 258 estimate, and revenue of $9.62 billion. That is a 12% increase here. The company also talking about payment volume at constant currency up 8%, cross-border volumes up 13%. So we'll be digging in here to get any more commentary and insight in terms of the read-through for the consumer, et cetera, as well as here is yet another company where on the conference call we are likely going to get some questions about regulatory overhang, as the government continues to look into Visa as well as MasterCard. So something that we should consider when we're talking about that company. But in the meantime, those shares up just around 2% here.
Yeah, this is another one, Julie. Most analysts like this name. The average price target is actually closer to like $313. I know on the call, a couple of things I know analysts want to hear more about, aside from just what's driving the business in the quarter. A lot of interested on feature space, which remember Visa agreed to buy that firm, kind of strengthen their financial crime and fraud detection portfolio. And also, of course, Justice Department's antitrust lawsuit. Those are going to be some obviously key issues on the call.
We did get a little bit of forecast look ahead from the company as well. Visa says that in the first quarter of 2025, its net revenue growth will be in the high single digits. Its earnings per share growth will be in the low double digits. And that for all of 2025, it's targeting earnings per share growth at the high end of the low double digits. So I don't know why they don't give us more specific range, but the high end of the low double digits. Right, I guess investors like that.
All right, let's keep going. Snap delivering third quarter results. Let's go get those to you. Beating estimates on the top and bottom lines. Company also authorizing a share buyback of up to $500 million. Stock's popping about 2% right now. Just quickly through the numbers. Q3 EPS 8 cents, Julie, that's a beat. Top line revenue 1.37 billion. Street was around 1.36 billion. So that just beat there. Daily active users 443 million. That looks better than what the analysts had penciled in. And then looking ahead, sounds like they're calling for Q4 revenue 1.51 to 1.56 billion. Expectation was 1.56 billion. And we can see the stock popping about 2.5% there.
Yeah, I mean, this one is swings so much after its earnings. Yeah. It's actually unusual, I think, to see it only up by about 3% here. If you just look at the company's past few earnings reports, you're talking about, I'll do this, high double, I don't know. It was they were down 27% last time they reported. They were up 27% the time before that. They were down 34% the time before that. So maybe this will change during the call and we'll get more of a move from the shares, but it's just interesting to see relatively, I mean, by Snap terms, this is like unchanged.
Very much.
Right? That we're
kind
seeing
of a
this
modest
kind of
reaction, actually.
Yeah, exactly.
Now, the big question, well, the company did unveil these changes in September, so remember it was like a new design, upgrade to the app, to the advertising tech, so that's going to be a big focus. How our executives talk about that on the call will be really interesting.
Yeah, we're going to dig a little bit more into Snap later on. Angela will be back to do that with us. Yeah.
Excellent.
Excellent. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. And Josh, on the other side of the break. We're both. You're busy reading earnings.
I'm neck deep in earnings, so I can't be reading these prompters anywhere. On the other side of the break, it's Asking for a Trend. We'll continue to break down the latest earnings report and get you set for tomorrow's opening bell. Stay tuned. AMD reporting Q3 earnings just minutes ago. The chip maker beating on revenue while earnings were in line with expectations. And joining us now is to help break down the report is Matt Stuckey, Northwestern Mutual Wealth Management Chief Portfolio Manager Equities. Matt, it's good to see you. So at least initially here, Matt, investors disappointed. Clearly after hours were down about 6%. But what do you make of the results?
You know, I think it was really an inline print and kind of looking at maybe some softness on the guidance for the fourth quarter. You know, they guided to $7.5 billion or so worth of revenue, but the composition of that is really going to matter. We're going to find out more about that on the call, specifically in the data center business. You know, there has been a rebound in traditional server with the launch of their Turin-based servers, and that's picking up some market share from Intel. But, you know, the most excitement around the stock is clearly around the accelerator business, which is launched this year and has a shot at, you know, putting up about $5 billion of total revenue. We just don't have those figures yet, and we'll find out more on the call.
So from what you're seeing from the numbers that we do see, what's your latest judgment in terms of how they're keeping up with the so-called AI arms race, Matt?
You know, we don't have a whole lot of information disclosed. I mean, it's all kind of lumped together in the data center business, which, by the way, did beat expectations. And so that's a positive first glance at what we know so far. But looking at kind of what's on the forefront for AMD as you look to 2025, there's a couple of acquisitions that they made to kind of really enhance the software ecosystem around their AI accelerator business, and that's what's really required for them to compete with NVIDIA, you know, over the coming years. And just to kind of frame a little bit of the size of the market, you know, NVIDIA is expected to generate, you know, roughly 165 billion or so worth of data center revenues in calendar year 2025, and expectations for AMD are around 10 billion or so as you look forward to next year. And so it's a huge market, and there's a huge opportunity for AMD to penetrate that if they execute. However, you know, we're just going to have to get more information on the call about the pace of those product releases, the pace of the software ecosystem being built around this launch, and of which they started earlier this year.
Let's talk about the core business too, Matt. You know, you think about the just overall PC market. Do you think that's generally supportive for AMD over the next 12 months?
You know, look, the client segment for AMD did bounce back this quarter pretty nicely and beat expectations. But as you look forward to 2025, there's some hype that's been building that kind of AI-based PCs are going to be kind of the next leg of growth higher for the AMD story. That's a little bit, to me, a more of an open question mark versus their ability to, you know, gain some inroads into the AI accelerator business, which they've effectively been doing. And the reason I say that is that, you know, the application kind of use cases for consumers to go out and swap out whatever notebook they have with one that's AI accelerated, to me, I just don't know if that resonates yet with the consumer. Maybe it will in 2026 and beyond. But if we're sitting here today and we're in the fourth quarter and we look into 2025, it's hard to put your finger on kind of the feature set, which would, you know, be mindful in the mind of the consumer and force them to upgrade.
So, Matt, you're looking at the stock that's up 13% this year, which is obviously an underperformance of a lot of the other hot semi plays. Does the valuation where it is right now make sense to you, given some of the reservations, perhaps, that you and other investors have, or would you be adding to something like AMD here?
You know, I think one of the reasons why AMD has trailed other semiconductors so far this year, it's because it's not the pure play AI story that NVIDIA is. You know, they've executed phenomenally well with a later start in the AI game, you know, launching a product and having it scale to a $5 billion number in the first year of a launch is an incredible achievement. But, you know, they're also involved in, you know, traditional PCs. They're involved with traditional servers, areas of semiconductors that are just simply not growing as quickly as AI-based accelerators. And so that mix there it's shifting in the right direction toward the data center where the growth and the margins are. But those other areas have been softer this year, growing in the you know, single digits on the server side and you know, roughly the same on the PC side. And so, you know, as those kind of headwinds kind of flip to tailwinds, maybe on a cyclical recovery on the server side and further penetration into AI accelerated based on the data center side, you know, the stock can still work. And so, it really just comes down to execution and their ability to kind of create a moat around the accelerator business.
I'm curious about, so we talk about AMD taking on, giant like NVIDIA in the AI race. Any concerns you have, about AMD and versus Intel and PCs? Because I do hear some analysts who cover the names talking about that. They actually expect Intel to get more aggressive, to start prioritizing, share over margins. What do you think?
I think AMD has done quite a nice job in terms of grabbing market share away from Intel. And Intel's struggles are well documented. And, as it sits today, it's hard to see them turning it around in the near term. And so if you look to 2025, our expectation is that they gain further share in server and further share in PCs. Now, that might cause Intel to have to start sacrifice price a little bit, but kind of with their margin structure being what it is today, they can't afford to take losses in their PC business to kind of preserve pricing. And so, to me, I think this is still in AMD's favor as it relates to kind of the near-term trajectory of both server and PC.
Matt, really appreciate that instant analysis. Thanks for coming on.
Thanks.
Time now for What to Watch Wednesday, October 30th. Starting off on the earnings front, we're just getting started. Two more magnificent 7 names reporting tomorrow after the close. Microsoft and Meta. Meta announcing third quarter results and analysts expecting strong ad pricing for the third quarter and a raise in CapEx fueled by AI.
Sticking with earnings, we'll be getting more big names tomorrow, including Eli Lilly, Caterpillar, and MicroStrategy. Eli Lilly reporting results for the third quarter in the morning after 2 guidance hikes already this year, driven by the expansion of its GLP-1 drug. Analysts are not expecting the pharmaceutical giant to raise again.
And taking a look at the economy, we're going to be getting third quarter GDP figures in the morning. Growth expected to hold steady at 3%, according to economists. The growth driven by consumer spending, something we also saw indicated by yesterday's positive consumer confidence print.
And moving over to housing, monthly pending home sales numbers for September are coming out in the morning. Economists forecast that number will increase to 1.8% month over month.
Coming up, Snap shares following their latest earnings report. We can see, check that out, up about nearly 6% here. We're going to get some analyst reaction on the other side when asking for a trend returns.
Snap topping earnings estimates for the third quarter. The social media company also authorizing a stock repurchase program of up to $500 million. Here with a closer look at the quarter, we have CFRA Research Senior Equity Analyst Angelo Zito back with us to talk about what we heard from Snap. So Snap seeming like maybe the sort of changes, the tweaking to its ad platform, to its platform generally, are sort of working, Angelo? Is that the read-through here?
It's a work in progress, right? So you kind of look at the numbers here. Top line was fine. Revenue grew 15%. Expectations were about 14%. The surprise, and I think really kind of the nice beat, was on the adjusted EBITDA side of things. It was about 132 million. I think our expectation was around 90 million or so. So that was positive because they've kind of disappointed on that side of things, I'd say, more often than not here over the last couple of quarters. And that's just because the AI investments are so, are very heavy in nature. But you kind of look at the guidance also, a little bit more mixed in nature. Revenue, I think, implies about at the midpoint about 13% growth. So it was a little bit below the 15% we were looking at. But on an adjusted EBITDA basis, again, it was a midpoint about 235 million, just slightly above where we were expected. So they're executing a little bit better on the bottom line. That's a good thing because that has kind of been an issue for Snap here over the last couple of quarters. I'd say on the top line side of things, again, it's a bit mixed in nature. They're kind of working on improving kind of the direct response side of things on their within kind of their ad platform, and then on the brand side of things, that continues to be a negative story. It declined again, I think, this quarter on a year-over-year basis. But I think also a very big positive is kind of what they're doing kind of on the subscription side of things. That is growing better than we would have ever imagined 4 or 5 quarters ago. I think that, with 12 million subscribers now, it's about kind of 8-9% of their revenue. So that is kind of some nice diversification and kind of adding to that top line growth.
And Angelo, correct me if I'm wrong, I think you do have a buy on this one. So what are the catalysts ahead, Angelo, you'd be looking for to move this one still higher?
Yeah, I mean, listen, Josh, I think, we upgraded the stock to a buy early 2023. The stock had traded from, $90 to $10 post-pandemic, and it started leveling off, and our view was it's kind of been beaten, to a large degree. Kind of the valuation, was starting to look a little bit attractive on our side of things. And the big reason we do have a buy recommendation is, this is a company that is growing their active user base pretty quickly still. I mean, it's growing about 9% of a year-over-year basis. The guidance that they provided here for the December quarter was a little bit above our expectations. Again, kind of growing 9% year-over-year. So, they're growing the user base out there very nicely. They're improving kind of the cost side of things. The headcount was down about, I think, north of 10% on a year-over-year basis, but the infrastructure costs have gotten pretty elevated. I think you're looking at kind of an infrastructure cost per daily active user at about 83 to 85 cents here at a run rate about those levels. About 5 quarters ago, we were talking closer to kind of a 58 cent or so level. So it's gone up significantly. But if they can start leveling that number off here, continue to grow the user base here, and find ways to kind of monetize that platform a little bit better, then all of a sudden you're talking about being able to scale that business. And that's something that they haven't been able to do here over the last couple of years. But we're kind of optimistic that they can start controlling the cost, kind of given the run rate they're at right now.
Angelo, you were talking earlier when we were talking about Alphabet about capital return plans. Well, here with Snap, we had a little capital return plan, $500 million buyback authorization. How much of a carrot is that for investors?
Not much, to be honest with you. I mean, if we're being honest about it, right? I think a lot of those kind of when you kind of think about the buybacks, at least for this company, it's largely to offset some of the increases in terms of stock-based side of things. So, this isn't a company like Apple, which has kind of reduced their shares outstanding by north of 40% here over the last kind of 12 years or so. So, to us, that's not necessarily kind of an important part of the story. But at the end of the day, it's always good to see.
Yes. All right, Angelo. Love it. Love the honesty. Good to see you. And thanks a lot for your time today.
All right. Thanks for having me.
Coming up, we're checking in on a few tickers that we didn't get to yet that are moving after hours on earnings as well. Stick around, more Asking for a Trend on the other side. a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is Market Domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
All right, let's take a look at what's trending after hours here. Reddit shares, they are soaring, hitting a record high in after hours. Trade company reporting better than expected third quarter earnings really across the board. Profit, revenue, daily active users. Reddit's fourth quarter revenue guidance also blowing past analyst expectations.
Shares of First Solar falling after hours. The company cutting its net sales guidance for the full year to between $4.1 and $4.25 billion. Analysts were looking for $4.42 billion. The company also missing third quarter earnings estimates, reporting $2.91 versus estimates of $3.12.
And our next mover, Caesars Entertainment. That stock moving lower after the hotel and casino company reporting a miss on revenue and earnings, a loss of $9 million in the quarter.
And then there's Chewy. Those shares are sliding. Keith Gill, also known as Roaring Kitty, disposed of his stake in Chewy. That's according to an SEC filing. The move coming after the trader had disclosed a 6.6% stake in the company back in July.
And that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.